Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the ultimate bull flag and the bear flag pattern trading strategy. These chart formations are essentially for understanding market trends and potential price movement. So by the end of this video, you have a clear grasp on how to identify and analyze the trade due to this pattern effectively. So stay tuned to enhance your trading skills and improve your market analysis. We start by understanding the anatomy of the bull and bear flag. These bull and bear flag patterns are continuation patterns that signal potential price moving to resume its direction in a prevailing trend. This formation consists of two main components, the flagpole and the flag. The flagpole represents a sharp price movement established during a trend direction. Now for a bull flag, this is an upsurge. As you can see, this is an upsurge. This upsurge is to the upside, while in a bear flag, this is a down surge. As you can see, this is a down surge, while it is to the downside. This is what the bear flag and the bull flags are all about. The flag poles are typically accompanied by high trading volume, indicating strong momentum in the market. And as we can see, when we saw the flag pole in the bearish market, there was an increased volume at this area. The flag is a consolidation phase that follows the flag pole. In a bull flag, you will see a consolidation that forms a downward slope or a horizontal channel. As we can see, in a bull flag, we can see this downward slope or a channel to the downside, as we can see. So this is typically what a flag is. While in a bear market, we see a flag creating an upward slope or an upward channel to the upside. As we can see, this is typically the bear flag. This is what we are talking about. These patterns are defined by their structures, parallel or slightly converging trend line that encapsulates price movement during consolidation. The retracements within the flag are typically ranged between 30% or 50% of the flagpole length. This is to maintain the integrity of the flag pattern. Now, if we are to measure using a Fibonacci retracement, we would see that the flagpole are usually around 50 to 30%. And if we draw our Fibonacci tool, we can see this flagpole was around the 38.20%. This is basically what we are talking about. Understanding these components will help you identify when the market is preparing for its next move, the breakout point, which occurs when price moves beyond the flag boundaries, above for a blue flag and below for a bear flag. This is below for a bear flag and above for a bull flag. You need to focus on recognizing these patterns accurately and understanding their behavior between different market contexts to provide for your trading opportunities effectively. Now let's see how we can apply the ultimate bull flag and bear flag pattern to our trading strategies. Applying the ultimate bull flag and bear flag pattern to our trading strategies requires precision and discipline. This approach combines pattern recognition with strategic entries and exit points to maximize your trading potential. We begin by identifying the overall trend in the market. You can use moving average or we can use market structure or price action. By identifying for a bull flag, you ensure that price is above the moving average. Now let's use our simple moving average for this indicator. We'll use our simple moving average. We'll use the 200 period moving average for this particular example, using the 200 moving average to give us a better idea of what is happening in price. And when we can see that price is consistently above this moving average, it signifies that we are in a bull flag area. The market is moving to the upside. While in a bearish market, when we are consistently below the moving average, it signifies that we are in a bear flag, or we are trading to the down direction. And as you can see, including when I included my moving average, you can see price is directly below the moving average, signifying that we are in a bearish market. Once you confirm your trend, you look for sharp price movement that forms this pole. Once we can see the sharp flat price movement that forms the pole, this is the pole here. You can see the sharp price movement that forms the pole, followed by period of consolidation creating a flag, and this is the period of consolidation that is creating the flag. You have to pay close attention to the volume during this period. You would observe an increased volume during the pole creation, and as you can see, when the pole was being created, we saw an increase in the volume. When there was a consolidation, we can see there is an decrease in the volume. During this consolidation phase, we can see that the consolidation started from this area, and we can see there was a reduction in the volume bar, signifying that the consolidation phase has a decreased volume. The volume pattern helps us to confirm the validation of the flag pattern. When you spot a potential breakout, be prepared to enter your trade. When you spot a potential breakout, we have to be prepared to enter our trade. For a bear flag, we look for a sell stop. We look for a sell stop. If it is a bear flag, you set your entry just below where you expect price to break out from. You set that below your below your now broken support line that turns to your resistance. So this is where you set it. And remember, risk management is crucial when setting this strategy. We have to set our stop loss to above the bear flag in terms of a bear flag situation. And if it's a bull flag you're talking about, when we enter at the breakout, we set our stop loss to below the bull flag. We can also make use of average true range to set our stop loss, but setting this stop loss below the swing low and swing high in case of a bear flag or a bull flag helps us to protect our capital and gives the trade room to breathe. Remember that you allow your trade to run. You enter your trade automatically when price breaks out. Whenever price breaks out and you see a clear breakout, that is where you enter your trade. Sometimes you can wait for a retest, but it's not always certain that you will see a retest. When you enter, in order for you not to miss the move, you enter the moment you see a breakout, either to the upside or to the downside. This is when you enter your trade. To determine your profit target, you have to measure the length of the flag pole. You can measure the length of your flag pole to determine your take profit level. Then you project that level from your entry point to wherever it ends. That is where your entry should be. This will be your estimated take profit area. I repeat, to determine your take profit, you measure the length of your flag pole and project it from the breakout point. This measurement makes technical moves and provides a realistic goal for your trade. However, remain vigilant and be prepared to exit the market in case the market condition changes. So immediately we notice that the market condition is changing or we notice a decrease in volume, we can decide to leave our trade. Remember, successful implementation of this strategy requires patience and practice. You will need to wait for your clear breakout and always adhere to your risk management rules. By consistently applying this approach, you can enhance your ability to spot and capitalize on this high probability trading setup. So therefore, you have to practice this on a demo account, or you can backtest these strategies to get more acquainted with this strategy before applying them in a real life market condition. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.